Continuing with the volatility calculation method. So we use BPV formula to assess to any change. What is the change of that investment? Change in that investment if there is a change of 1 basis point. So 1 basis point interest rate change, what will be the impact on your assessment? That is what the BPV tells you. That is the one example which we did is about 1 basis point. What is the change in that particular investment? What is the formula which we use is change in price divided by change in market rate into 0.01. That is 1 basis point. So that is the example which we did in the last session. So question that part 2. So in the first case study, we find that this one, the change in market price divided by change in price divided by change in market rate into 0.01 gave you 0.02. For 100 rupee, 2 paise is the change in that impact of the change in the investment, change in your investment, market investment. Now the question number part 2 continues. Calculate BPV for 1 crore. So for 100 rupees this much, 1 crore is this much. Use the simple formula, simple arithmetics. For 100 rupees we found that the BPV is rupees 02. So that is the formula which we used in the last session. BPV from market price, change in market price divided by change in market rate. So price divided by rate into 0.01. So 0.02 for 100 rupees. If 0.02 is the BPV for 100 rupees, what will be the BPV for 1 crore? So then for 1 crore, how much? So BPV of 1 crore for 100 rupee, it is 0.02. Then for 1 crore, how much is the? So 2000, simple. So there is no need of any explanation further in that. So 2000 rupees will be the BPV for 1 crore rupees. Like that for any amount they will ask. Only thing is you have the formula, you know the formula, change in market price divided by change in market rate into 0.01. Use that formula, find out. For 100 rupee this one, then if you know that for 100 rupee this is the BPV, for any amount you can find out. So in that way questions may come. So for 100 rupee, 0.02 we found out using that formula. Then for 1 crore, this one is 2000 rupees is the BPV for 1 crore. For an 1 crore investment, for every change of that is the meaning. So for 1 crore, BPV is 2000 mean what is the meaning? What message it gives to you? It gives the message that for 1 crore investment, for every change of 1 basis point, that is 0.01 percentage, that value, your investment value changes by 2000 rupees. That is what the BPV tells you. That is the volatility. It tells you how much volatile is your investment to the change of 1 BPV. That is the message which BPV gives you. That is why we follow calculation of BPV before investing, before taking an investment decision. So this investment has, if 1% is 1 basis point changes, this investment will have a BPV of 2000. So on calculating some other investment, you find that the BPV will be 1200. Higher the BPV, higher is the risk. So that is the investment decision helping tool which we use to calculate the market risk analysis. So for 1 crore rupees, now you know how to calculate this one. So question number part 3. For again it is asking, if the question continues like this, for rupees 1 crore investment, BPV is 2000. Suppose market rate comes down. Here it is mentioning about another scenario. The story is continuing and they are saying that suppose market rate comes down by 8 basis point. For 1 basis point, we know how much is the change. Now the question is simple. The question is asking, for 8 basis point, what will be the BPV? We have already calculated 1 basis point change. How much is the 1 basis point change? Then they are asking, if there is an 8 BPS change, what will be the BPV? So answer, for 1 basis points, the change is 2000. Then for 1 crore rupee. So this is asking about a 1 crore rupee investment. So 1 crore rupee in the last part 2 section, we have already arrived at for 1 crore, it is 2000. The BPV was 2000. Then for 8 basis point, BPV means for 1 basis point it is 2000. Then for 8 basis point, what will be the BPV? What will be the change? 2000 into 8. For 1 basis point it is 2000. Then how much will be for 8 basis point? Simple. So 2000 into 8. So this is the answer. 16,000 is the BPV for a 8 BPS change. For 1 BPS change we know. Now we have calculated for change for 8 BPS. Rule is market rate comes down means gain for investor. That means the market rate has come down. Whatever the bond price, the bond which the person who holds the bond, his investment value, his bond price will gain. There is a gain for the investor because the bond price rule, remember, when the market rate comes down, the existing bondholders' bond value will go up. So there is a gain for investor. At the time of maturity, BPV will be 0. So at the time of maturity, BPV will be 0 because there is no change in, because he got all the money matured and he received all the money. Then there is no point in calculating the BPV at the time of maturity. So at the time of maturity, there is no scope for parallel movement in yield curve because already whatever the money which we have already received. Then there is no movement. Then what type of movement, whether it is there upward, downward movement, it will not affect our investment because our investment has already matured. That is why there is no point in calculating at the time of maturity of the bond, this BPV. So BPV's calculation is valid during the tenor, during that maturity period, during that time period of that bond period. From starting, which is a 5-year bond, from day 1 to 5th year. So the BPV calculation will give you a message. What type of risk, how much interest risk it carries, like that. Now, value at risk. VaR is called a VaR. VaR is another method of telling you how much risk that particular investment has. So maximum, if you are investing an investment, suppose 1 crore investment you are investing, this VaR will tell you how much is the maximum loss you can incur. So how much is the loss? Beyond that, there is no chance of going up beyond that level, that particular level. That is the calculation which they make, and it will give you the message that this will be the maximum loss you can incur. If you are prepared to take this much loss, you go for it. Higher the loss, higher the profit. That mantra you remember? Like that, if you are prepared to take this much risk, okay, 1 crore is your investment. I am telling that the VaR for that 1 crore investment, 10 lakhs is the VaR. Means there may be a chance of 10 crore incurring loss at any time. If you are prepared to take that loss, your investment sometimes may gain 200% growth. There is a chance. If you are prepared to take that risk and chance, provided you are ready to accept this VaR level. And also, this VaR will tell you a confidence level. That means, if a VaR statement says that 1 crore investment, 10 lakhs is the value at risk, means the maximum loss you can come across during the tenure of this holding that security. So, this much is the maximum loss, and also this much is the confidence level. Means, if they say that 99% is confidence level, that means I am confident that the investor says it is. So, the investor, the issuer says that the confidence level for this particular investment is 99%. That means the VaR of 10 lakhs will not exceed 10 lakhs because it is confidence level is 99%. That means for 99%, there is no chance of exceeding your loss beyond 99, beyond this 10 crore. So 10 crore will be the maximum loss you can come across, you can experience, you can incur. So that loss, if you are prepared to take that loss, you go and invest because the confidence level is 99%. So what is the meaning of that? 99% is confident that this VaR, that is the loss, will not exceed 10 lakhs. But there is a chance of 1% non-confidence. That is the non-confidence level. The non-confidence level, what it says? There is a chance of going beyond 10 lakhs VaR. What is the chance? 1% chance, because they say that 99% is the confidence level. That means 1% is the non-confidence level. That is what the VaR says. So on reading through the VaR statement, you will come to know what will be your expected loss in your investment. What is the confidence level in your investment? What is the non-confidence level in your investment? So accordingly, on seeing this VaR, you can take a investment decision. It is a very good risk-taking, risk-measuring tool in the risk management portfolio. So whenever you are going to invest in a big investment, so always we use this VaR statement. You read through the VaR statement and you compare investment A, B, C, D, E. What is the VaR percentage? What is the VaR amount? What is the confidence level? What is the non-confidence level, like that. So this statement will tell you how much is your investment value going to lose. How, at what percentage of confidence. So what is the non-confidence level? On comparing everything together, you will come to a conclusion that I will go for investment A or B or C or D, like that. So for taking an investment decision, this will help you a lot, VaR. So that is about the VaR. So VaR is, we use this one in the downside potential mainly to find out, to assess the loss potential. How much is the loss potential? It is one of the volatility method calculation tool where we use to assess the maximum loss potential. What will be the loss? What is the expected level? What is the confidence level? What is the non-confidence level? And during which period? So it will tell you the periodicity, it will tell you the confidence, it will tell you the non-confidence, it will tell you the value of security, it will also tell you the maximum amount of loss which you may incur. So that is what the VaR states. Let us see one by one. The second method of risk measurement under volatility is value at risk. So BPV we know now. Now value at risk. Value at risk describes how much the investor can lose. Maximum in a portfolio. What is the loss potential? That is more important. So VaR describes, that is MCQ. These words may come, this kind of questions. So VaR will tell you dash and that, this and that. VaR will tell you how much the investor can lose maximum. Or in the question it may be, the VaR will tell you what is the loss potential. You remember these two words, loss potential. VaR will tell you the loss potential or how much the investor can lose maximum. That is the loss potential, the one word for this one. So that is the loss potential in a portfolio. What is the loss potential? It is a statistical method of calculation. So VaR will have, value at risk will have one amount, time horizon, confidence level, maximum loss potential. This also in the questions you can expect in MCQ. So VaR will have A, B, C, D, like that. Amount will be there. So how much is the value of your investment? Time horizons, what is the periodicity? Then what is the confidence level? Suppose it is 99% confidence level. Then also it will have a non-confidence level. Non-confidence level will be 1%. If confidence level is 95%, non-confidence level will be 5%. If confidence level is 90%, non-confidence will be 10%, like that. So on comparing this, you can come to a conclusion. Which one is good, which one is bad, which one we will go for. So what is the confidence level? What is the amount of VaR? Time horizon, level and the maximum. This is the value at risk VaR. Maximum loss. That is the value at risk. That is the maximum loss. This is the value of investment. Value of investment. This is the value at risk, maximum loss. Loss potential. Maximum loss potential is called a value at risk. So what it is explained? Rupees Y say Say 10 lakhs. 10 lakhs is the VaR. So one statement it is stated that 10 lakhs is the VaR. 10 lakhs, which has a time horizon T, because the VaR says the VaR will have amount and a time horizon. The VaR statement, the time horizon also will be given, T, period T. Confidence level, say 90%. That means, this means with this time period of T, suppose time period is 100, 90% is the confidence. Time period, say that within a period of, time period of 100 days. Within a time period of 100 days, 90% is the confidence level, means 90 days, this 10 lakhs VaR will not exceed. That is what the meaning, that is what the implication of this statement, that is what it gives you the message. So, this means within this time period of T, this is the prediction. What is the prediction? 90% is the prediction. Within this time period, 90% I am confident that this loss will not exceed 10 lakhs. So, this is the prediction. So, confidence level 90% means 10%. Out of 100, 90% is the confidence level. 10% chances are there where VaR may exceed rupees 10 lakhs. That is what I was telling you, that one statement, one investment says that the VaR is 90% confidence level of 10 lakhs. 10 lakhs is the VaR, 90% is the confidence level. 10% is the non-confidence level. In another investment, they say that 10 lakhs is the VaR, 99% is the confidence level. There 1% chance only is there for the non-confidence. So, we will go for this 99% confidence level. Like that. So, we compare confidence and non-confidence level. We compare the value at risk also and the time period also. So, on taking a view, the overall view, we will come to a conclusion. That's the beauty of this VaR. Confidence level, say 99% means chance to exceed is 1%. This is the Z value. See, another term. This is the Z value. Z value is nothing but the non-confidence level. Non-confidence level. Then what is this confidence level? Confidence level 90%. What is this? This is the nothing but the standard deviation. Isn't it? Standard deviation. That means your VaR, your loss may incur. Your investment, you may face a VaR, value at risk of 90% of 10 lakhs. That is the standard deviation. So, what is in the Z score? What is above the standard deviation, which is in excess of the standard deviation? Deviation above the standard deviation is Z score. That is nothing but the non-confidence level. Hope you understood the concept. The Z score is nothing but the non-confidence level. What is above the confidence level? That is the non-confidence. So, what is the confidence level? Is the maximum loss, which may pull your investment down to an extent of 10 lakhs here. That is the standard deviation. What is above the standard deviation is, which is the non-confidence level, that is called the Z value in VaR statement. So, Z value, this is the Z value, this 1% is the non-confidence level, which indicates how much a given value differs, from the standard deviation. Differs from a standard deviation. Standard deviation is nothing but the VaR. Maximum loss you can incur. You may incur VaR. So, what is above VaR? That is the non-confidence, which is called Z value. So, Z value is nothing but the deviation from the standard deviation. So, what is above the VaR? 90% is the confidence level. That is the standard deviation. So, above that 10% is the non-confidence, that is the Z value. Mostly in the case studies, they will give you the Z score. You need not calculate the Z value. The Z value will be given in the numerical. in the question itself. So don't worry about the calculation of Z value and all, but for the understanding purpose, you understand that for your academic interest, I am telling you this is the Z value is nothing but the non-confidence. So VaR is a way to figure out how much money you could lose over a certain amount of time with a certain level of certainty. That certainty is called a confidence level. VaR is a way to figure out how much money, that is the VaR amount, you can lose. The 10 lakhs example which we discussed in the last slide. So you could lose over a certain amount of time within a certain level of certainty. Certainty means confidence. For example, a one-day VaR of your portfolio is 5 million. One-day VaR means the loss which you may incur is 5 million with a 99% confidence level. So what is the meaning? Means that there is only a 1% chance that you will lose more than 5 million in one day. One day VaR is, it is for one day period. The time horizon is given, it is one day. For one day, there is a chance. For 1%, that means out of 100 days, 99 days the VaR will not exceed 5 million. At least for one day, it may exceed. There is only a 1% chance that you will lose more than 5 million in one day. That is the meaning of confidence and non-confidence level. One example, just let us see one example. A bank having one day VaR of rupees 10 crores. So, the one day VaR. One day VaR rupees 10 crore. So, that means VaR amount is given. Amount is given. Confidence level is given. 99% is the confidence level. Confidence interval means that there is only one day in 100 days. 99% means if your time period is 100 days, only one day in 100 days or 2.5 days per year based on 250 days. 2.5 days, 1 day, 100 days, 1 day, 200 days, 2 days, 250 days, 2.5 days. That is what the calculation says. 1 day in 100 days or 2.5 days per year if the year has 250 working days. 250 working days in a year, where the daily loss will be more than 10 crore under normal trading conditions, which means in 100 days on only one day, the maximum loss will exceed rupees 10 crore. That is what this example. So, because the VaR is 10 crore, confidence level is 99%. Only one day, only 1% chance is there, this VaR loss will exceed 10 crore, which is the value at risk. So, that is what the VaR statement says. So, VaR has time horizon, value of investment, value of amount of loss, confidence level, non-confidence level. So, these 5 things which will have, this VaR statement will have these 5 components. One question let us see, let us discuss a question. Question 1, one day VaR of a portfolio of rupees 5 lakhs. That means the VaR of a portfolio, VaR is given, the value at risk is given as 5 lakhs. 95% is the confidence level. So, 5 lakhs is the VaR, 95% is the confidence level. In a period of 6 months, how many times the loss on the portfolio may exceed 5 lakhs? Assuming that there are 250 days in a year. So, the question is asking, in how many times the loss in a period of 6 months, the loss on the portfolio may exceed 5 lakhs, assuming that there are 250 days in a year. This is the question. One day VaR is given, confidence level is given. So, it is asking one day VaR, this is the thing. 6 months, this is one day. One day VaR is 5 lakhs. In 6 months, how many times the loss on the portfolio may exceed? That means, what is the question is asking for what? You just think of, use a logic. How many times the loss on the portfolio may exceed? may exceed. The loss on the portfolio may exceed means what? It is mentioning about the non-confidence level. It is asking for the non-confidence because 95% chance is that it will not exceed 5 lakhs. So, in a period of 6 months, how many times the loss on the portfolio may exceed 5 lakhs? Non-confidence. Assuming that there are 250 days in a year. So, how will you go further? So, answer will be here 1 day VaR. So, take out your worksheet, write like this. 1 day VaR is how much is given? You just copy from the question that 1 day VaR is equal to 5 lakhs. 5 lakhs is the 1 day VaR. Confidence level 95%. Means here may exceed. Here it is asking may exceed. That means the non-confidence. So confidence level 95% means 5% is the non-confidence. 5% is the non-confidence. Period 6 months, half yearly, that is 125 days. Because 250 in a year. Assuming that there are 250 days in a year, the question is asking in a period of 6 months. So we need to find out half of these 250 days. So 250 divided by 2 will give you 125 days. So it should be our step-by-step answer in your worksheet should be like this. First you read through the question, then you copy from the question the what are all the things which you have to pick from the question is 1 day VaR 5 lakhs, confidence level 95, non-confidence level 5% because 95 is the confidence. Period is 6 months. So that how many days? Because 250 days only in a year. So 6 months period divided by 250 will give 250 divided by 2, 125 days. Then what is the next step? Answer is 5% of 125. What is the non-confidence level is 5%. So how many days? What is the question? How many times the loss on the portfolio may exceed 5 lakhs? So we need to find out the non-confidence level days. 125 days half yearly, out of which 90% is the 95% is the confidence level, 5% is the non-confidence. So our answer should be 5% of 125 days. So 6 days is our answer. So how many times the loss on the portfolio may exceed? 6 days. It is simple because half of 250 is 125 days. 125 days into 5%. So 95% confidence level means 5% is the non-confidence. So 5% of 125 days will give you the number of days in which the loss VaR may exceed 5 lakhs. That is the way in which you need to find out the answer. So like that, so many questions will come. There are 1 or 2 examples which we will work out here. So question number 2, VaR you can expect definitely 1 question of either 1 mark or 2 marks, something like that. Some marks you can score from VaR. So it's a very important topic in risk management. Risk measurement rule, particularly in market risk, the assessment and the portfolio investment. So 1 day VaR of a portfolio is rupees 5 lakhs with 97% confidence level. We are talking about 95 earlier. Now the VaR is 5 lakhs. 5 lakhs is the VaR. 97% is the confidence level. So then in a period of 1 year, assuming again 250 working days in a year, in a period of 1 year, how many days the loss on the portfolio may exceed 5 lakhs? The simple like last time. Here the 97% is the confidence level. So the non-confidence level will be 3%. So what is the question is asking for? In how many days the loss on the portfolio may exceed 5 lakhs? Very simple, it's very simple. Earlier it was 5%, now it is 3%. So answer will be 97% confidence level means 3% chance are there to exceed 5 lakhs. Therefore, 3% of 250 days, because 250 working days, it is stated already in the question. So 3% is the non-confidence level because 97 is the confidence level. 97 is the confidence level. So 3% is the non-confidence level. Therefore, 3% of 250 days is 8 days. 250 into 3%. So 8 days. The answer is 8 days. When we do some numericals, we will do more questions like this. So VaR is very important. So this is the way in which you need to proceed. So understand the concept of this VaR. What are all the components it has? How to calculate? How to arrive at the confidence, non-confidence level, number of days, value at risk amount, time horizon, etc. Another sample question, let us see. One day VaR of a portfolio is 5 lakhs. With 90% is the confidence level. So it says that 90% is the confidence level. Then in a period of 1 year, assuming 250 working days in a year, how many days the loss on the portfolio? Here you see may not exceed rupees 5 lakhs. So tricky situation. So you have to be very careful while reading this question, reading through this question, find out may not exceed. May not exceed. It is not asking about the non-confidence level. It is asking about the confidence level. It will not exceed. In one day VaR is 90. One day VaR is 5 lakhs. Confidence level is 90%. In a period of 1 year, if one day VaR is 5 lakhs, 90% chance, assuming that 250 days in a year, how many days on the loss portfolio may not exceed? So 90% of what? 1 year, 250 days, it will give you the answer. So step 1, non-confidence is 10%. That is 10% because confidence level gives 90%. 10% of 250 days is 25 days. 25 days is the 10% will be exceeding, which means 90% of 250 days. That is the confidence level, which is because it is asking may not exceed. May not. That is it is asking for the confidence level. So 90% of 250 days. That is 225 days. The portfolio may not exceed 5 lakhs. That's the answer. That is 90% of 250 days. It is 225 days is the answer. So like that, so many questions will be there from the examinations which you will have. So VaR is the maximum loss within a confidence level. VaR is useful for potential protection of a customer investment. VaR is an important tool for market risk analysis. Formula for one day VaR is equal to value of the investment. See, if you are asked to find out one day VaR, this is the formula. One day VaR is equal to value of the investment. Z score, as I stated earlier, it will be there in the question. It is about the non-confidence level calculation. It will be given in the question, that Z score into standard deviation. So you can find out one day VaR. If you are able to find out one day VaR, you can proceed with the finding out how many days, 64 days, 90 days, 3 months, 6 months, like that. So this is the way in which we do VaR calculation. So in the next session, we will have some more explanation about VaR, and we will proceed to the next state of the step of risk assessment, which will be a risk pricing.